Welcome back from spring break, everybody. It was weird to not come here last week. We did start, though, while we were gone. We started our classes at Sierra College, so we're doing 4 weeks there. Let me tell you, it's a lot of information to take from the 12-week course and cram it into 4 weeks instead, so that was really fun. I feel like I'm just chasing my words over the slides the whole time, but I wanted to make sure that we put in, just based on a couple things that happened recently. I want to make sure that we're reminding you that these seminars are being recorded and that we're posting them on our website, or on our YouTube rather, for people to refer to later. So if you don't want to be involved in that, just let us know and we'll do our best to make sure that nothing of yours gets captured and put out there. But for the most part, we're totally focused on us. Camera's not catching any of you, but just in case you have any concerns, please let Shaniqua know if possible. Yes. Oh, sorry, wait. Where am I doing that? Uh-huh. Okay, there we go. Yep. All right. Okay, now we're back. Okay, so let's do a little bit of a recap of what we talked about last time. And for that, we were talking about our objectives and basically just the different ways that we can think of the structure for our portfolio, what the purpose of it is going to be for. So here's all of those again, going from current income all the way to maximum growth, talking about basing things on income generation for current income, having sort of an income focus, but with some growth for balanced, having a growth focus with some income for growth and income, a growth focus on growth, obviously, then maximum growth for those people who just want to go all the way equities all the time. Then we talked about our risk tolerances a little bit. So moving all the way from conservative to speculative, pretty much kind of a mirror of what you'll see in objectives. I would say most of the time they're going to line up pretty well, but depending on your personal risk tolerance, you might pick a balanced portfolio and skew a little bit more growth heavy or skew a little bit more income heavy. We went back over a lot of the stuff that we talked about in terms of portfolio building, just to remind you kind of what we were using in order to actually craft our portfolios. So here's another reminder of all those risks that we're looking at. And remember, this is really pointing us to why we like broad-based diversified investments, because we want to make sure that when we diversify, we're essentially getting rid of as many of these risks as possible, down to such a small number that it's kind of ineffectual in the long term. Most of those can be attributed to single stock positions or single country positions, and it's pretty relevant to talk about single country risk, especially recently, where now international markets have followed the US a little bit more, but initially when the drop first happened, internationals were holding quite strong. Things like a Vanguard Global ex-US fund or any of the other developed markets funds, they were holding very strongly while the US market started to tumble. And that was providing a lot of stability for people who were diversified globally. So it's really important to be diversified as much as possible. You won't always get the best returns, because the best returns come from concentration, but the most risk comes from concentration. So that's why it's really important for us to look at those objectives, to look at those risk tolerances, to understand why we want to diversify away from them when that's the most appropriate. Then, of course, we've got our systematic risks, which are the ones you can't get away from, but the things you can moderate your exposure to. So if I don't want to take on a whole bunch of market risk, I'm probably not going to buy a whole lot of stocks, because that's what comes with the territory. If I don't want a whole lot of interest rate risk, I'm probably not going to buy a whole bunch of bonds, because again, that's what comes with the territory. And if I don't want a bunch of purchasing power risk, I'm probably not going to hold a lot in cash, because that's where you're going to lose the most. Then we talked about how we manage, how we use these concepts from lateral and vertical integration, kind of how you are spreading things into multiple stages. So when we look at the first stage, these are the things that you're hoping are not moving up and down too much. These are the things that you would liquidate for distributions. These are the things that are the least aggressive, cash and cash equivalents, ultra short-term bonds, things that are just places to park assets and you're not expecting to grow much. Maybe you get a little bit of yield. Moving on to stage 2, where we look at a little bit more of an intermediate time horizon. We're looking at longer term debt, balanced funds, maybe some more value focused funds, things that would have greater loss, but for the most part, we like these to be strong in yield, because we like for them to have some dividend income that we can use to reinvest at lower prices when they do get hit by market declines. Then stage 3, This is the type of stuff that's hurting the most right now. This is when we're talking about growth. We're talking about concentrated sector funds. We're talking about the big, the S&Ps, the NASDAQs, the big indices that move around a lot that people talk about when they talk about volatility. That's what we're talking about here. That's the long-term game. That's where we want to get our growth. That's the most aggressive. So we talked about both of those types of risks. We learned about lateral integration, how we use it, which is both lateral integration, time-based investing, and vertical integration, which is our diversification. And then we looked at the 3 stages and our little diversification pyramid that we built as sort of a graphic representation. And we put all those together and we built a little sample portfolio, if you remember that. We made a little sample portfolio using all those concepts, and it ended up landing as a really nice, low-cost, balanced portfolio as a sample. And then we talked about all of the fun, particular stuff, evaluating investments with something like Morningstar. So we learned about a couple concepts from modern portfolio theory and how they appear on a Morningstar report. We talked about beta, alpha, R-squared, standard deviation, mean return, Sharpe ratio, and we used all of those things to be able to assess the risk of holdings, and also we learned how to assess the risk of bond holdings in funds and in portfolios, so that hopefully we got a really good idea of how to look at our investments. Now, just before we move on to what we're going to talk about in this class, which is sort of after the completion of portfolio construction, reevaluating it over time. Do we have any questions based on anything that we just kind of skimmed through right now? Is there anything that anybody wants to clarify before we move on? No? Okay. So today we're going to start into phase 3 of our process, which is after we finish constructing the portfolio, after we finish doing our basic financial planning, what do you need to be doing continually for the rest of time to make sure that you're up to date consistently? We want to make sure that everything stays together, that it continues to serve our needs, and that we're not falling out of balance as time goes on. So there's a couple different pieces, key pieces that we want to be looking at. One, we want to be monitoring our portfolio. Obviously, this is the one that people get stuck on the most. They spend the most time on. They try and do the most optimization, but in my opinion, that's probably one of the more passive things that you can do in this process. More importantly, you need to make sure that your estate plan continues to fit your needs and continues to put your assets where you want them to go. And secondly, it's important to have some tax efficiency, because if you're simply just handing over tons of money to the government every year, you're not getting the most out of your assets. There might be better ways that you can pull from. Most of the time we can't escape taxes, we can't escape capital gains taxes, but oftentimes if we have a particular need, we have to take a moment to look at our pile of assets and think about where we can most efficiently draw from. So when it comes to portfolio monitoring, we just really want to make sure that it continues to serve our goals and objectives, our cash needs, and our risk tolerance. Those are the most important things. So if just with this recent market volatility, some people would have made big changes to their portfolio out of fear. They might have had a big drop in their holdings. Maybe they have some growth funds that really came down. And if you're looking for tax loss harvesting and you're changing things and they fall in line, that's fine. But oftentimes people will sort of handicap themselves in the long term by moving out of the market at a time of volatility, when that's just part of the ride. That's just part of what's going to get you there. I use this phrase over and over and over again, this little quote. I use it over and over and over again, and I feel like a lot of times people don't really let it sit in, but if you miss the 10 best days of the last 30 years of the stock market returns, you will have your returns cut in half. In half. And that's 10 days out of 30 years. And those 10 days, they often come after the really bad days. We just saw that, like within a week of today. We saw that the market was down and down and down, and then the S&P had a 9% day. A 9% day is ridiculous. That was the biggest percentage swing since COVID, and I think it was the biggest point swing ever intraday from bottom to top. That was the most points the S&P's ever moved in a single day. So it's really important to stay invested through a plan that's going to fit you. And the way that you're going to do that is by understanding your risk tolerance and knowing what you're going to be comfortable with on a day-to-day basis and understanding how it actually serves those needs, which is why everything that we talked about previously leading up until now is so important, because that's what keeps you on the right path. Yes? Mhm. Yeah. Mhm. Yeah. So, couple things for that. One, there's a lot of assumptions that get made about the stock market is that all investors are rational. And obviously now you can tell that's not the case. Secondly, what the stock market is thought of what's called a leading indicator. And that's sort of like forward projections of what people think is going to happen, because that's how people invest. People buy and sell stocks based on what direction they think the market's going to go or particular sector. So when something happens that makes people afraid that their strategy is no longer going to work, they want to abandon and switch to the next thing. And that's kind of where it is. It's like a sentiment indicator. It's how people feel. And because so many people are ready to trade so quickly based on the same information, it'd be different if all of these big institutions had like a front run on all this information, then their volume probably wouldn't move very much and just us little retail. But because everybody operates with essentially the same information until they're trading illegally, we're all kind of, we're all playing the same game. We're all trying to gamble against the same outcomes. So it's just like, as soon as that information drops, that's the first time everybody hears about it. So the reaction gets priced in very quickly. Yeah, absolutely. Yeah, exactly. And a lot of the times, like when it comes to Wall Street, buy and hold investing seems to work 99% of the time above everybody else. But for some reason, they're still trying to find new ways. And so they're still trying to create new strategies. They're still trying to do new things. And oftentimes, a lot of these managers, they'll do really well for like one little year. And then they think they can extend that through all market conditions and things change. So it's just really complicated, but it really just comes down to people thinking they're going to be smarter than the rest of us. And at the end of the day, it just doesn't end up being true.
Yeah, we saw the same thing. I thought in year 50. And we were all waiting for the government to come up with a plan, and yes, they're gonna lend them the money, and yay, the market's up, and no, they're not, the market's crashed. We're all trying to predict something. Nash has an article in the book that it goes through the wave of here's where the market is, and then we get all excited, and then the beginning, what happens here is people speculate that the tariffs are bad. Okay, maybe they are bad. They start to sell, then the big traders see, okay, the public's getting nervous, let's sell and cause it to go down more, and it falls even more. Then when they feel that it's at a bottom, let's get in before everybody else gets confident. So you have valid concerns, but then again, maybe you don't. We don't know that. But we saw that, and because I remember being stressed out all night, right, in 2008, sitting up in my bed, yes, please, no, it's up, it's down. And it was all based on the bankers or the government or what people were going to do. And we could blame other people for it, but the market keeps moving on. Because the first stock Nash bought dropped quite a bit in 2008. He was there. And then he was able to keep buying and we came through it. So it's a cycle, and it's in the book, actually.
We just have to live long enough to benefit.
Right. And his third stage of growth, that may be down, but the other two stages, first one's not. Second one might be a little bit of bruising. If you could separate those and look at your statement, some of your funds might be doing okay, and some of them aren't. And then again, those are longer term, or we should buy some more.
Yes.
I guess I want to follow up a little bit, or push back slightly, because it sounds like these big investors are just reacting. And, the description that I'm hearing from you is that they're just so irrational. But I don't think these people are irrational. I mean, they're professional investors. So, and they're all kind of all going in the same direction.
Mhm.
So how do you respond to that?
Well, I would just look at their track record.
Yeah.
Have they actually done that well? I argue not. I argue based on returns, the only funds that really do the best are the ones you don't hear about because they don't take any investors. These funds make money based on having money in the portfolio. They don't usually make money based on the actual trades. Sometimes they do, and sometimes they become very successful doing that. But for the most part, the people who really make the money are the people you don't hear about because they don't want you to. They don't want you to know that. They don't want you to know about what they're doing. And a lot of the biggest fund companies, I mean, Vanguard Fidelity, Schwab, the reason that they make money is not because their strategies are good, but because they have yours, because they have your money in their portfolio. So that's kind of how I would push back against that. And yeah, just the track record just doesn't hold up most of the time.
It's impossible to know how people are gonna react to what information. So if something comes out of the day, we don't know how they're gonna react. I'm always blown away thinking, I think it's gonna go up and then it goes down, vice versa. But if you buy really good quality, some people ask us, should I buy gold? Should I buy T-bills? The bottom line is, if you're hyper diversified among stocks versus bonds, and then this fund versus that fund that's different, because he'll talk about correlation and things, then different fund companies, we always come out the other side as long as there's more people being born going back to the table. But some of the things are overpriced, like tech stocks, they can't be, and you're gonna make a lot and you're gonna lose a lot. And that's why his diversification of time frame versus the different types of investments, we can just build a stronger wall. Because even if you're cheating with inside information, you still don't know what 100 or 200 million traders are gonna do tomorrow. We don't know how they're gonna react to it. And some people have this one opinion out of fear, and the other one's optimistic. The main thing is follow his objectives and risk and needs. We come out the other end. But if we don't, if we sell everything, we miss it. Or if we buy everything, it tanks, one or the other is going to hurt us.
Yeah, and even if we just kind of look at recency bias, it's been really easy to be a growth investor because growth has done nothing but go up for, I don't know how long, 5 years, 7 years. It's just been, if you just look at sort of that recency timeline, growth seems to outperform everything. And it's like, if you want the returns, why wouldn't you invest in growth? But then if we back up for a while, value outperforms. So why wouldn't you just invest in value? And then if you look at very particular timelines, well, it seems like global does better than US. So it's just about, for us as investors, the main thing that we're looking for is we're looking for long-term stability and reliability and protection from different types of individual risks. The other reason why big traders and big portfolios will follow these things is because they're trying to mitigate their short-term risk as much as possible, and they want to try and get out ahead of things. And so a lot of the times when you have very big investors, very big portfolios, they want to mitigate their short-term risk a lot. So they want to try and pull out before volatility hits. And oftentimes that just ends up to people trying to make these educated guesses. And when you look at a lot of indicators, things can look like really high success rate. Like you could look at, if you're just a technical person, you're looking at moving averages and you say every time it crosses like this, that's when you need to get out. Or somebody looks at fundamental things. But the problem is, even if that works on average, most of the time, there's always going to be these outliers. And it just seems like so often these outlier situations happen, like recently, and people just make these decisions and they just pull their capital out, and then we see it drop. And then you see the tariffs get paused for 90 days, and then it rebounds by 9%, which is just absolutely ridiculous. And it's hard to understand how that could be a bunch of rational decisions, because if it was so rational, why are we seeing, a drop by 8–10% and then a spike back up to 9% 2 days later? Well, I mean, any of these big recession times would be outliers. And even things like just recently, I mean, there have been other talks about tariffs that didn't send the market into 10% declines over 2-day or 3-day periods, or even something like COVID, where, it felt like it was going to be the end of the world. And then the stock market just decided to keep going anyway. And I was personally kind of shocked that things just stayed strong through that period. And then obviously, not for super long, but when those interest rates stayed nice and low, it was like there was no reason to have money anywhere else than the stock market. So it's just, there's a lot of different examples, but things like 2008, 2020, 2022.
It's hard to tell. People with utilities. Utilities went through the roof. Anybody know what I mean? We were sitting there scratching our head last year or so.
Mm-hmm.
We need to reduce this utilities. They were up 35, up to 50, depending on when the client got in, 50% in a fund. Utilities. And we're going, okay, let's sell off some and buy Vanguard real estate fund. It was down 60. It turned out to be a good move, but it wasn't because we know why. We found out later as we researched it, that utilities went up because of all these planned data centers being built. They're gonna have to move electricity around.
But they haven't happened yet.
They haven't happened yet, but it's in anticipation of the future, right? And that's why stocks sometimes move up beyond what their multiples and their earnings and all that. And then we bought real estate. We're really proud to say, hey, we're up 16%. And we're really smart, but why did it go up? Well, that's because they're starting to buy the data centers, the real estate where they're gonna build those out for AI. So you don't always know.
But you don't know, and
Yeah.
anticipating, again, this person at the top whose whims run like this, there's no anticipation, you don't know that, so how do you?
Where you build a proper balanced portfolio, because also in 2020, when inflation had gone up for whatever reasons, we could argue about that, but it had gone up and the Fed had to raise interest rates. We saw obviously bonds crash. If you had long-term bonds, he doesn't do long-term. They were down 20 to 45%. But the tech stocks crashed when during the pandemic they didn't. It was the dividend paying stocks during the pandemic, because if everybody's gonna shut down and not pay dividends, that stock's gonna drop during the pandemic. Growth stocks kept going up because that was anticipated 10 years from now. But in 2020, when interest rates went up, people stopped wanting to wait for those growth stocks when I can get 5% in CD. So they bought CDs and the stock market and growth stocks crashed.
We want to make sure that our portfolio is continuing to serve our goals and objectives, cash needs, and risk tolerance, like I mentioned before. So our primary focus is going to be our overall portfolio allocations and the types of assets and their functions. So if we're trying to build an income portfolio, a whole bunch of growth funds are not going to be great. We've talked about why that's the case. If we're looking for tax efficient investing, again, making sure that we have tax-free income or preferential tax income, something like qualified dividend income, which is really nice, where if you have dividends that become qualified, they get taxed at capital gains rates. And that's really, really fantastic, especially if you can have some nice dividend paying stocks where you get some growth potential and you also get qualified income. There's a couple different things about that. For individual stocks, it's really easy to figure out whether your dividends are qualified or not. I believe you have to, there's some period you have to own it within, you have to hold it for a certain amount of time, then the dividends become qualified. Now with an ETF, the ETF has to follow that holding period and you have to hold the ETF for the same holding period. So it's a little doubled up, but a lot of the really good dividend ETFs tend to follow that. Anyway, so let's just look at an example of when we might need to readjust our allocations. So if we've got an investor that is exclusively in growth stocks up until right now and has seen massive returns year over year, let's assume that the last couple of weeks haven't happened yet. Let's just say we're right at the top. But the investor has no bonds or bond funds and earns minimal yield. They don't really earn anything in yield. Maybe they get that 1%, 1.5% from growth stocks or S&P 500 fund. And we want to assume that their distributions are going to fund retirement and that the present value of the account is enough. The money that we've got right now is totally enough. On a nice conservative basis, we'd be totally fine. So as the investor starts to near retirement, what are the challenges they're going to face if the allocation doesn't change? Those are the challenges that they're going to face. If you don't change your allocation rolling up to retirement, then you're going to face a situation where you could have the portfolio drop down to a point that it can't sufficiently support your needs, especially if you have pretty aggressive distributions. Because you got to understand that a 3% distribution now, after the portfolio allocation goes down by 20%, now becomes a much higher percentage of that portfolio. And now you're drawing more of the principal year over year. So all the distributions would have to require a sale of the assets in the portfolio. And what that means is that you're selling assets that are down. We don't like selling things that drop in value because we want to give them the time to recover. We like buying stuff that's down because we get to buy it at a discounted price and watch it rise. So there's a really substantial risk that the portfolio could see a big decline, just like we saw recently, right before the distributions. And that's not a fun thing to experience. Their risk is really high. So how would these concerns change the investor's goals and objectives? Well, the investor would likely shift their goals to preserving their capital, first and foremost, because if they've got enough money to pay for retirement, they probably don't want to lose it. That's also just something to make them emotionally feel better, but also mathematically to just make sure that we retain a strong likelihood of success. So the investor would likely be advised to adjust their allocations over time to suit the new goals and objectives. So What kind of securities might the investor consider for their new allocations? Any ideas? We got growth funds right now. What would be some other stuff we want to throw in there? International is an interesting idea. Anybody else? Well, we think having some dividend paying or value equities would be helpful because now you get to take some current income out of those equities. That's nice. Some government debt, treasury bills, notes or bonds, those are historically much more stable than equities, especially if we go to the really short term. Right now, they're being kind of sold off a little bit, but at the same time, if you look at the overall volatility of something like a treasury bill, even at a time like this, it's still nothing close to a growth security. So if you're minimizing that standard deviation by a lot, that helps you have security in the investments that you're going to pull from. You might have some corporate grade debt or some investment grade corporate debt, something that pays a really strong dividend, something like, I don't know, middle grade triple Bs or something like that. But the main similarity between a lot of these is not necessarily they're super low risk. It's that they're paying yield. And now we can take that yield and use it to fund distributions versus with the growth securities, every time we want to take money out of there, we got to make a sale. So if we're not selling principal, we're giving that principal the opportunity to grow. And if we don't need the yield, we can reinvest that back in. And then of course, we've got our cash and cash equivalents because in our opinion, we like to front load distributions with things like cash, things like short-term treasury bonds, treasury bills, and we like to park it there so that you can have the rest of the portfolio can do whatever it wants. But I turn and look at my cash and I go, that's where I'm going to take my assets from, and I'm not worried about the rest of the portfolio. It's got time to do its thing. So knowing all of this, what's likely to be the investor's new risk tolerance? I've got a couple options on here, and I'm just curious, what do you guys think? We probably started up here in the aggressive to moderately aggressive with all of those growth funds, but if we're funding retirement, where do you think we're going to land? Moderately conservative? You know, that's a pretty good option. That's right smack in the middle of what I would choose, depending on what the value of the account is, depending on how long we're expecting to fund distributions, depending on how aggressive those distributions are, we can land in any one of these places. Now, I'm glad that you guys are paying attention. So you should do more than this, though. Basic allocations aren't always going to protect us when markets turn sour. Obviously, we have what happened recently, and sometimes you just got to wait it out. But sometimes just having stocks versus bonds is not going to be enough. If we just go back to a time like 2022, if you had longer term bonds, those didn't do very good. Target date funds were down 30 to 35%. That was really, really rough. But if you were in something like a short-term treasury bill, it didn't hurt quite as bad. That's not to say that the return of those treasury bills is going to be better. The total return of longer term bonds outpaces every single time, but we're paying attention because if we want to mitigate the short-term risk, we have to give up some of that total return. It's really important to understand what your trade-offs are here. So hands-on investors should do a lot of things. On a daily basis, we think it's important to just be aware of the current events, to just be aware of what's going on. If you're not aware of what's happening, you can't be aware of the changes you need to make. Very true. Now, one thing I will also kind of attach onto this is it's important not to allow all of the current events to make you make a change every time you hear one. If you change something in your portfolio day to day, back to back, every single time that something happens, you're probably just going to end up like all of those people trying to trade options, and your return's going to erode away and you're not going to be very happy. But it's important to just be aware of the economy that you're sitting in. Be aware of the circumstances that you're in. So if there's some kind of major change that suddenly sets everything off track for you, that you can make a change for that.
So I'm curious, so much misinformation out there.
Yeah.
And to truly get the facts of what's happening,
Mhm.
what's going on, what do you guys want as far as a reliable source of information?
Yeah, so a lot of the times we just like to look at multiple sources because you can't really ever trust one. I like Bloomberg for a lot of news stuff. Most of the time, I don't read their opinion pieces ever just because I don't really like reading opinion pieces in the first place. But they do have a lot of good information. And, you know, if they've got a nice live show that they've got on their app, on their YouTube and all sorts of stuff, and they'll be very up to date on a lot of things, a lot of articles. And then also just kind of paying attention to a lot of the economic indicators. Things can be helpful because when there's all this noise of what people are saying they think is going to happen, the data is really the important thing to be looking at. But again, I would be looking at something like Bloomberg. You got anybody else that you like listening to in terms of news?
Listening
but we'll look at Morningstar as well. To see what the numbers look like.
Yeah.
Because when you listen to social media or some cable news, if they're left or right, they're gonna have their only slant on it. And one of the things that came out recently was, okay, well, he's gonna do the tariff, so they traded the market and sold short, now they're gonna make a bunch of money. But then the other side of it is, this guy's been talking about this forever, so it wasn't a big surprise. And we didn't know how much people may or may not react, now we say, oh, I should have gotten out, but like Nash says, if you got out and didn't get back in, then the rebound came up quite a bit. And the market itself is still, the overall Dow is probably down 12 now instead of.
Something like that. Let me see.
And 6.5%.
Yeah, 6.6. Yeah. Mhm.
Yeah. Yeah, but
Yeah.
and the other thing, he likes the dividend stocks, not because they're better than growth, but they give you a second chance. If you have a dividend stock like, I think it was Schwab's value stocks or something's paying 3%. Well, if I get 3% a year and the market never goes anywhere, in 3 years, I'll have 9% more. And if it dropped 9, then I might break even. Not that that's the way you want to invest, but it gives you a second chance to be reinvested.
Yeah. So then more importantly than just simply what's happening in the current events is really understanding the changes to the tax code or the laws. That's where it really becomes important. That's why being up on the current events can be important, is because you can be aware of like the proposed tax changes that are coming through. But if that happens and suddenly other ways of using your assets or other places that you can pull income from become more efficient, it's important to understand where the switches could be made. Or if there's more advantages that you could be taking to have a more tax efficient investing plan long term, it's really important to be up on those tax codes, be up on the laws, so that you can make the right decisions for efficiency. Keeping an eye on the activity of the Fed is always a good one. Interest rates, monetary easing or tightening, understanding when they're buying and selling different treasuries and when the interest rates move up and down. We were kind of shocked when when 2022 happened and interest rates were basically at the floor. You weren't earning anything on money at high yield savings accounts or money market funds. It was basically flat. And people were really stretched into long-term bonds. And then the interest rates just ratcheted up and up and up and up. And those long-term bonds, those fell kind of to the floor. That's when things were down 30%, 40%. And if you just sat in your 10-year, 30-year treasuries or corporate bonds or whatever, you were going to feel a lot of pain from that. But you could have reduced your risk by being in lower duration treasury bills, short-term government or short-term corporate bonds, and all that sort of stuff. So sort of just understanding the environment that you're in, really important. On a weekly basis, just monitor fund news, updates, and alerts. I get alerts on whatever funds are in my portfolio, so I make sure that if something happens, we can be up on it. Like recently, one thing that we had happen with some client accounts is there was a JP Morgan sustainable ETF, and they just decided, we're going to close it now. And so when that happens, it basically generates a sale for you and you don't get to choose. So it's important to be up on that to understand if you're going to now have this extra bit of capital gains because the ETF decided we don't want to do this anymore, that's something you've got to manage. So being up on those different things and making sure you understand what's happening with the assets within your portfolio, really important. Measuring your key portfolio and fund metrics. If you just plug your portfolio into something like Morningstar, or if your brokerage firm has any sort of analytical stuff, being able to plug that all in and say, is this still sitting in the right area? The other thing where fund alerts can be important is sometimes the more actively managed bond funds can decide to just change what the duration of the bonds in the portfolio is. They might be a short-term bond fund for right now, and then they decide, all right, it's time to start sticking a whole bunch of intermediate and long-term bonds in there. And if you weren't looking, if you weren't paying attention, that could increase your interest rate risk without you being aware. That might be okay for you, it might not, but you don't know unless you're looking. So note the runners and detractors of your portfolio. Not that you want to be actively managing any of that by any means, but it's just kind of nice to be aware of what the circumstances are that are contributing to their performance, whether it's outperformance or underperformance, so that you can make smart decisions moving forward. And then, of course, continue your education with podcasts, articles, and more from reputable sources like we talked about. You don't want to just be listening to the incredibly opinionated people on whatever side of it is. You want to make sure that you're listening to sort of non-biased information. And even if you listen to people who talk about opinionated things, just verify what they're talking about and just go look at what is the information that they're sourcing. But I will say there are a bunch of really great podcasts that I like to recommend every once in a while. I'll give you a couple of those right now. Let me pull up my library. Let's see, we got some shows. So Money Matters by Allworth is a great one. That's actually some local financial advisors who take a bunch of calls from clients that have questions. If you're thinking about Bloomberg, they have a show called Business Week, which is really great. You can either listen to it live or they put it on the podcasts app. Also, Bloomberg Surveillance. Pretty much anything by Bloomberg is pretty cool. That's nice. ETF Prime, if you really like learning about the individual investments, ETF Prime is great because they talk about new ETFs that get launched all the time, and they talk to the actual managers and the creators of these ETFs, so that's cool. Let's see what else. Morningstar has a bunch of great ones. Investing Insights is pretty cool. I like that one. Schwab has a cool show called Schwab Market Update. Basically, if you just like to be in the know in the morning, you could throw that show on and they'll give you sort of a pre-market idea of what's going on out there. Morningstar also has one called The Long View, and Schwab also has one called Washington Wise, which is kind of just taking the political landscape and the investing landscape and helping you understand how they come together. So that's a bunch of suggestions. If anybody's ever got any ones they want us to check out, I'm always happy to do that as well. Now, on a monthly basis, this is when it's time to go shopping. It's one of my favorite things to do. Look for new funds that meet your objectives better, offer historically more favorable risk-adjusted returns, not just number go up, but make sure that it's fitting in your risk profile, that it's not extending your risk a whole bunch to switch over to it. Or if they're just cheaper for the similar thing. If you're sitting in, say, an old growth mutual fund, it might have done pretty well, but you might be just losing a little bit with like a 1% fee. If there's not really much of a reason to pay that fee, swap yourself over to a Vanguard or a Fidelity where you pay next to nothing. Fees are always going to be the #1 detractor of returns. So if you can get the same thing for cheaper, get the same thing for cheaper. This is where it's always valuable to do that. And you can also use, and you just want to use this as an opportunity to bring the overall portfolio cost down. Like I said, fees are the main detractor of returns. When I'm building portfolios for clients, I don't like putting them in super high cost mutual funds because I feel like if they're paying anybody a management fee, it's me. I don't need to also then have them pay a whole bunch of money for the products in their portfolio. We can do really easy portfolios. The sample that we built a while ago, I think it cost less than 1/5% for the whole thing. That's pretty good. A lot of times when prospects bring portfolios in, they're charging an average of 0.5% or even 0.75%. Or I just remember the most ridiculous portfolio I ever saw. One of the positions had like a 1.2% management fee. I'm not finished. And then there was debt charges. The interest got kicked out to the investors as well. So that was like another 2% on all of the holdings. So we're talking about like a 2.5%, 3% total management fee for being in this fund because it was just very particular. They did leveraged debt stuff and it was just a lot going on. And in my opinion, it's not that that investment is necessarily the worst thing in the world, but there's no way that was suitable for the person they had in it. So that's just kind of the important thing. If you understand it fully and you're willing to pay that fee, all power to you. I'm sure it was some great yield, but I just knew it was not suitable for that person. So quarterly, that's when it's important to really start diving into the metrics of your portfolio because this is when, there's a decent amount of time you can see the changes of things back and forth. This is generally where if people are doing more automatic rebalancing, they're either going to rebalance quarterly or annually. I like to look quarterly. I don't always like to rebalance quarterly because sometimes that can handicap returns too. Sometimes you need to let the year run and let it do its thing. But it is nice to look to make sure that we're not just completely off track. The main thing when it comes to rebalancing is not that we think that our allocation is going to be the right one in every single circumstance, but it's really about managing that downside risk, making sure we're not overextending ourselves for something like a whole bunch of growth funds that are going to drag us down in the next quarter. Yeah. Yes.
Loss positions.
Oh, yes. Mm-hmm.
Buy loss positions versus the market fluctuation, because if you're looking at it now, you go, oh, holy cow, this is down, but then in a month, let's change it. So
Right.
Where do you get your? Where do you
Right. So for me, for loss positions, in terms of replacement, what I'm looking for is I'm looking to replace it with the same thing but better quality. It's not that I want to make a change in terms of shifting from growth to value. If that's what I want, fine. But let's just say, for example, if we're looking at, say, a S&P 500 fund, if you got into that and it's down really hard right now, let's say you got in right at the top. I know some of my allocations were like that just because that was the timing that we had. And then you have like a 10% decline on the S&P. And you decide, I haven't put any, let's say maybe you haven't put any internationals in there and you're ready to, maybe you could buy a total world equity index fund where it's very similar. You're going to get the same S&P exposure. Maybe you add in some international, but it's just, you're making a little lateral shift over to the side and you're getting a similar exposure and maybe including something else in there. Or another thing is if you're in a more heavily managed fund that costs a lot and you want to get similar exposure but in an index variety, something very cheap, that's when I would make that switch. And that's particularly good because, for two reasons. One, if you're in a taxable account, you get a nice little tax loss. That's always nice to be able to take that and apply it towards some other things. But secondly, because the fees can be such a strong detractor of returns, if you move from a high cost investment to a low cost investment right after a really strong decline, and then you can feel the rebound in the thing that costs a lot less, your returns don't get dampened down by that fee. So that's kind of like what I'm talking about when I'm talking about loss positions. It's more about looking for the same thing, either cheaper, higher quality, or better suitable for you, not necessarily looking for some outrageous investment opportunity that's going to make something.
Selling that.
Yes. Yeah.
It would, fractional shares, some companies try to $7, some don't. The main thing is if the market's down, you don't want to sell that and get something different. You want to sell that and get something very similar, so you have your rebound. And if the market's up too much, you can sell that and buy something different because you're up a lot. And the cost of buying and selling is very nominal, although you have spreads he'll talk about, or Schwab made a ton of money the day after the market crashed a lot. Any ideas why? Buying and selling possibly. The other thing is the more cash that sits in your account and isn't committed, they pay you 0.5% or 1%, they make 5%. So Schwab's is a banker. They're not into buying and selling so much. They make more money just leaving the cash there or lending you money to trade. But the spreads and all this stuff, Nash knows more about. They make little fractions of amount, but it's that cash.
Yeah, actually, to that point, there's a lot of lawsuits going around about that cash right now. Big funds, or not big funds, big investment advisors and broker dealers are getting a lot of heat for not paying their customers proper cash rates. So because basically it's just like a savings account. So the brokerage account will go, we'll give you 1%. That's good enough for cash, right? You're not doing anything with it. And then they'll go cash in the 4% somewhere else. And then they'll keep the difference and just basically let you not make the money on that when you could have just, bought a money market fund, but they'll default you to their cash program to make sure that they make that spread. So big broker dealers, pretty much every big name in the space is going to be facing this. So if you get a letter saying that we went through this thing and had to pay a fine, it's probably not going to be unique to your broker dealer. That's going to be pretty much everybody in the space, but that is something that is really interesting.
Outside mutual funds, let's say a Schwab or something, right? Schwab makes part of their management fee or a fee of some sort. So if you have outside mutual funds with Schwab or any other broker, those mutual funds have to pay a fee to be in Schwab to be able to be bought and sold. And Schwab may be making part of their management fee. That's why he likes exchange traded mutual funds or ETFs, right? Cheaper.
Yeah. So the couple things that you'll want to be monitoring in your portfolio on this quarterly basis is just all this stuff that we talked about in phase 2, making sure that your objectives are in line, making sure that your risk tolerance is where you want it to be, make sure that you're still comfortable, that you're not making any panic decisions, making sure that you're getting the right amount of portfolio income, making sure that that portfolio income is of the type that's most beneficial. if you're going in terms of what's the most tax efficient to the least tax efficient, you'll have things like regular interest all the way over here on the side, things like corporate bonds. Well, you'll pay your ordinary income on that all the way. Then you might go to treasuries where you stop paying the state taxes. Then you'll go to municipals where you pay no taxes. Then you'll also have something like dividends where you might have ordinary dividends and qualified dividends like we talked about before. So kind of just looking at your 1099s and your taxable accounts and seeing, all right, how much money am I paying on this money? Like, is this really efficient for me? And most of the time that only becomes really important at the higher income tax rates, because when you're at lower amounts, it's just harder to justify, because when you're looking at something like a municipal bond, you have to think about, if you look at this municipal bond and you look at something comparable that's fully taxable, there's going to be a difference in the interest rate that you're going to earn on it. For example, you might get, let's just say some sort of corporate bond is going to pay you 5 and the municipal is going to pay you 3. Well, there's a ratio of the difference there. That 2% difference, if you would have paid that to taxes, then that's great. We can keep that municipal bond. But if that's not enough to make up for the amount of taxes you're paying, if your taxes are only 15% or 20% effective, that spread is not really going to be worthwhile, and you would keep more after taxes staying in the corporate. So there's a little bit of napkin math to do there. But anyway, risk-adjusted returns are also really important. For the most part, this is usually going to come when you're looking at active versus passive funds. Passive funds, you're not really going to get too much extra return. Active funds, that's where they're going to try. Most of the time in the equities, they don't succeed. Sometimes in the fixed income, they do. But just looking at numbers like alpha or Sharpe ratio to understand if you're making extra money with the management fee or if you're losing extra money to the management fee, that can help a bit. Fund expense, probably one of the number one things that we'd look at in a portfolio. Extra money to fees is just extra money that's gone out of our returns. I don't like spending a lot of money on investment portfolios. It just doesn't make any sense to me. If I can pay 50 basis points over here, but I could pay 15 over here, and I get effectively the same exposure, I'm going to take the one that's cheaper every single time, especially if the volume is good enough. Getting rid of undesirable funds, making sure that anything that's really what you don't want, get it out of there and make sure it's not part of your portfolio if it's not going to generate a giant tax burden for you. Biannually, maybe this is when you look to rebalance and reduce your overperforming funds for underperforming sectors. Maybe once or twice a year you look through and you say, wow, that tech fund has just done incredible year over year for a long time, but now it's starting to extend my risk profile. I'm starting to get a little bit more worried about how that's going to perform. You could trade it off for something that's not performing super well. That's what we like to do for sector rotation. A lot of people like to do active things and think about what's going to be the next sector to go. We just go, what's on sale right now? Or recently, what's on sale is technology and consumer discretionary. So remember that sector tractor that I showed you before. I'll pull that up again just so that we can see it. This is always one of my favorite things to look at if I just don't really know what I want to be buying, is I'll just pick up something like this, go to the year to date and go, all right, what's the most on sale? And like you can see, just like what I said, technology and consumer consumer discretionary are down the most. Consumer staples actually up by 1%. Yippee! But that's a nice place that I like to go in case I'm curious what's on sale. All of these different sector funds are pretty much this sector as represented in the S&P 500. So I think that's always a really interesting thing to look at. All right. So on an annual basis, this is going to be also one of the most important ones, is reviewing yourself and making sure that your objectives and risk tolerance, liquidity needs, or any other part of phase one of the process, has any of that changed? Because the portfolio could be the best portfolio in the world for you 5 years ago, and it could not be the right one for you today. So it's important to understand how that's actually going to line up. Are you at a point where you need more cash now? We might make some changes. Have you had some sort of windfall and now you don't really need the cash? Well, I'd prefer not to have it sitting in money market funds this whole time. Maybe I want some more growth out of it. So just understanding that if any of this changes, make sure that you get your plan to align with it. Go through your diagnostics again. Make sure your cash flow is well represented, make sure your insurance coverages are where they need to be, make sure your estate planning is where it needs to be, and your assets are going to go where you want it to go. Do your tax planning with your CPAs and make sure that everything is still the most efficient. Don't be scared of change. If something about your portfolio or your needs change, don't hesitate to act on it. Just go for it. You don't need to do anything at the perfect time. You don't need to wait for the right moment. You just need to make sure that you're always doing the best thing for you. If you're doing this yourself, you are your own advisor and fiduciary. Hold yourself to the same standards that you'd hold somebody like me. You want to make sure that you are doing everything in your power to make sure that you have set yourself up in the best way possible. And so there's a bunch of stuff that has shifted our outlook in the real world. There's a lot of times in history where the game changed and we needed to adapt. So let's take a look at some of these examples. Maybe this will make this feel like not the only thing that's happened before. So the big one that I always like to reference is 2008. That's because I was alive for this one and I have a little bit more context for it. But let's just go through what happened. So we had what were called subprime lenders. And these were mortgage lenders that were helping people, basically giving cheap loans to anybody with a pulse. Anybody that could breathe. If you wanted a mortgage, you got your mortgage. Has anybody seen the movie The Big Short? That's one of my favorite movies ever. I love that thing. I got to watch that again now when I get home. Dang. But that was really interesting because they just kept giving out these loans. And after the dot-com bubble, the Fed lowered the federal funds rate from 6.5% all the way down to 1%. And that's the rate that banks lend each other money at. So those low rates, super, super small, just made the prices keep going because anybody could get a mortgage and buy basically whatever house they want. So that demand just kept going up and those prices just kept going up. So those low rates, they were sending house prices just further and further up. Now, what was interesting was we get all of these subprime loans. We get all these loans that were of bad quality, people with bad credit scores and bad history. And what Wall Street would do is they would take a nice little bundle of these and they would go, why don't we just push these all together into one product, package it all, make it all look nice, and then we'll call it a mortgage-backed security or collateralized debt obligation, which is basically saying, oh yeah, we've got all this debt in here, but it's secured by an asset, so it's fine, it's high quality. And then they would take those little packaged investment products, take them over to the ratings agencies. We talked about this a couple classes ago. And then the ratings agencies would go, yeah, that's a AA. That's a AAA. Why not? When we're really looking at single, double, or triple C type debts in there. So we've got really high default risk packaged as a really low risk investment, which is just pretty much fraud. That's just what that is. We're just misrepresenting a product as something else. So the problem was the rates finally started to come back up. Interest rates were starting to come back up a little bit. It wasn't so cheap anymore. And then we had these wonderful adjustable rate mortgages where people had their rates locked in for a while. And a lot of the times they thought that maybe, they were going to be they were going to buy this home. They were going to hold on to it while their initial rate was locked in. They were going to renovate it up, make it really nice. They were going to make money before the adjustable rate ever kicked in. Unfortunately for them, homeownership reached a bit of a saturation point. And there weren't so many people available to just keep buying houses and keep buying houses because everybody was doing it. And now that everybody was doing it, there wasn't anybody to be the customer anymore. So when they weren't able to sell their home before the adjustable rate kicked in, rates kept going up and up and up. And now this super high interest rate kicks in and suddenly you can't afford the mortgage. So the defaults on these subprime mortgages, remember, these mortgages that were given to people who already probably couldn't afford the first mortgage in the first place, now those payments are going up and up and up, and the defaults are just going completely out of control because there wasn't any control over who was getting these loans and what was happening. So the borrowers were owing more on the loans than the houses were worth. They were underwater on homes. That is a scary situation to be in. And because these were giant, giant companies that were participating in this through the whole time, the giant companies were on the verge of collapse. Huge lending companies. They were ready to just completely fall apart. And the housing market just crumbled, and you get to a point where people are holding onto these homes, super high interest rates, super high purchase prices, super low appraisal values right now. Yes. It feels really obvious after the fact, but when we're looking at things like this, and we saw that when you're looking from the outside in, you're looking at investment products that are rated AAA, that are supposed to be safe. You're saying, oh, exactly, but we didn't know that. You know, us as retail investors, even most people professionally, they just didn't know that. They just thought, oh, this is just a really nice collateralized debt obligation that has a ton of mortgages. Mortgages are strong, nothing's going to happen. Mhm. Well, I think the other thing about that is because people had been succeeding at flipping for a while, you know, there was a time where it actually did work. You know, you could just go buy a home, get your adjustable rate mortgage, put a very low down payment, whatever. You get in there, you do a little bit of work, and now you sold it for $100,000 more. I know a lot of parents of people from my class back in the day, they wanted to do that. A lot of people tried to do that. I think one or two people succeeded once or twice. But then everybody else wanted to follow suit and got in towards the tail end. And then everything just came crumbling down. But you just think when times are good that they're just going to keep being good. I mean, I think that's another reason why people are so shocked about the volatility right now. You know, it's just they keep thinking that it's going to keep going up and up and up. And you have a down day and go, oh my God, what's happening? It's like this has to happen. Yes.
Been adjusted to this kind of thing, or are we still at the same level of overcome? Are we wiser?
I would say that we definitely are wiser. There have been more, I forget exactly what was put in place, but there are definitely more checks and balances, and especially in terms of giving out mortgages and things like that. There's a lot more verification, because at that point we were talking about one of the examples in the movie that I referenced was they were talking about no income, no job loans, where they just kind of left everything blank and signed it through. That's really not going to be happening today.
Has anything been done in collectively to address other types of risks or vulnerabilities similar to this?
Yeah, it's a good question. You got any insight on
The
that?
biggest problem here is prices were going up. Here, when you buy in the stock market, unless you borrow money from Charles Schwab to buy more stock, most people pay dollar for dollar. Because you run into a problem with anything when you start borrowing to buy that thing, because then now if it goes down 10, you can lose twice as much. But when he was at school, the parents would come over and ask me, you're a financial planner, should I buy this house and flip it? We were at a huge peak of prices, and I said, sure, in Tennessee or Texas or somewhere, but if you're gonna do it as a rental, prices are way too high. You're gonna buy it for emotional connection, that's one thing, but if it's dollar for dollar cap rates and all that stuff, California is not the place to be. They were way overpriced. But greed got in at the lowest level, with people wanting the house to make the money. Then the mortgage broker wanted to sell you the mortgage. They didn't care, and all the way up to Wall Street. And some of these big people at the top actually lost a lot. Lehman Brothers and all that failed. So there's conspiracy, obviously, but not as much as we worry about. But if you buy dollar for dollar and it's in the open market, because the actual value of the stock isn't really real until you sell it, right? So if you don't want to go so long term, then you back out of growth stocks. And if you start buying blue chips, that's great for us in the next day, but that's horrible long term because they don't grow like growth stocks. That's the dilemma. So proper planning, that's the bottom line.
Yeah.
Did they pass legislation though, like they always compare it to the Tower Amendment way back when, that was like 15 pages, and the new one is now like, 1,500 or something.
Yeah.
But they're trying to roll back some of those. It really put in a lot of fiduciary things.
Yeah, and the banks are a lot stronger than they've ever been, because before, it's like FDIC, we all think that's safe, but they have less than 4% in reserve to cover all the banks. So if they all went under, good luck. I'd rather do T-bills and treasuries because they print the money, but then it's not gonna be worth anything. It'll feel better print. At least I got green back.
Yeah, so I forgot what the name of it was, but I just looked up and remembered it. If you want to look this up at some point, it's called the Dodd-Frank Act. It's something that Obama signed in. So if you want to learn a little bit more about that, that's something that you could specifically go to.
Buy and sell stock and get into it, then they work, and each time they're allowed to get into it, they scale it, they want as much profit as possible, and then make it as easy as possible for people to buy and sell, buy and sell. So that needs to tighten up a little bit.
So as a result of all this that we're talking about, the housing market fell and over 25 subprime lenders straight up went under. They just went completely under. The United States, the two largest home lenders in the United States, Fannie Mae and Freddie Mac, were seized by the government because they weren't able to keep this up. We saw the largest bankruptcy in US history to that point, which was Lehman Brothers. And now here's an interesting chart that shows you the cost of the 2008 financial crisis. Fannie and Freddie bailouts, $187 billion. TARP bank bailout, $440 billion. ARRA tax cuts and spending, $831 billion. And the Bear Stearns bailout at another $30 billion, with a total cost of just under $1.5 trillion for 2000. That's exactly right. Anybody know how many people went to jail? One guy.
Who was that lucky?
I don't even know. I don't even remember who that was. He was just nobody. It was just some nobody. And all of these companies, they just either got bailed out or they keep doing business.
They will argue that they paid the money back plus.
Right. Right, of course.
Yeah, they did. We almost went under an AIG insurance, almost crashed. And he'll talk about annuities. That's what we don't like because you're putting all your eggs in one insurance company and they almost failed across the board. Whereas if you had a bond fund, at least you had corporate bonds or treasuries spread out. And in 2008, I felt safer with stocks and bonds than I did with the US government because at least they had balanced balance sheets. So it's kind of interesting, but they did have to pay all this back. Some banks were forced to borrow money. They didn't want to, not sticking up for them. It's just that we did get the money back.
Yeah. So we can't predict these market recessions, but we can manage a bit of our exposure to them. Obviously, if all asset classes fall across the board, you can't really predict that. But the damage from overallocation to the wrong places, that would have been lethal. That would have been something that just completely takes you out. You don't want to be at a point where you're at 100% stocks and then the stock market just completely crumbles by 50% and now your money is cut in half. That's why we keep talking about over and over and over again, talking about asset allocation and making sure that you understand what types of assets you're using for what types of situations, what types of needs. So, a couple recent things. We had supply chain problems. This was a little while ago. We had the cost of products just increased by a ton. Inflation just started skyrocketing. Remember when just things couldn't move around, things were stuck. We had just boats and boats of product just stuck at the water, and it just wouldn't come in, whether that was due to some supply chain problems over here, or that was due to some people who were deciding not to work and protesting based on whatever it was. There was a lot going on at that time. And it affected companies' ability to produce goods. So they had to jack the prices of those goods because they were still in demand. Remember when eggs just disappeared from the shelves? Remember when toilet paper just disappeared from the shelves? It was gone. The demand was so high. That was kind of really confusing when just suddenly one day everybody wanted toilet paper really bad. They were just thinking, oh God, COVID is going to make me just empty my bowels for the rest of time. And I guess that was what people were scared of. And then, of course, there was the pandemic. And when it comes to real estate, it drove workers out of the office. Everybody was working from home for a while. And people have been fighting to get people back in the office in some places. And now we're at a pretty good hybrid version of that. But commercial real estate did not do super great in terms of retail and office space because there was nobody there. Nobody wanted to be out. Warehouses did all right because storage for e-commerce was still really important. E-commerce had a huge boom, and we had to be able to support that with infrastructure, kind of like utilities for the AI. But the retail and office space didn't do super well, still not valued super high, especially in comparison to residential. The difference between residential and commercial right now is still kind of wild. And then, of course, we've got things like the tariff concerns right now. Market volatility is all over the place. I mean, we're having days that are just swing up, swing down, swing up, swing down. There's a lot of greater uncertainty for the future that's driving this. The effects go across industries because these tariffs have been not super specific, especially before we knew that there was going to be a pause, when it was just this complete blanket application of tariffs. That was going to affect industry after industry after industry. The reason why tech was going down so far is because all the products that they were going to be sourcing were going to be hit majorly by these tariffs. And I mean, even just thinking about, I remember I was thinking about how I got a Japanese car, and I was thinking like, oh, now there's going to be a 25% tariff on Japanese products. Lucky me, I got in at the right point. So it's just kind of like all of these industries, they affect everything. Everything. Social Security funding was something that I haven't heard talked about much recently, but I remember a couple semesters ago we talked about it a lot. There were people were doing running numbers on Social Security because there's not enough inflow in terms of tax revenue to pay for the outflow of the income. It's drawing down the reserves over time. It's going to last for a while, but it's like having a stock portfolio where the interest and dividends earned are not enough to pay out, and you're just slowly decreasing the value over time. So there's an unsure future for Social Security. Most people here are probably going to be all right, and you're going to receive your Social Security, but I'm looking at, hey, where did mine go? I'm not going to have that in the future if it keeps going this way. So it might be worth planning to not expect something like Social Security to come through. So it's really important that no matter what is happening, you're staying nimble and ready to react to whatever goes on, and making sure that your portfolio is actually going to be able to sustain these things. So making sure that you have the proper allocations, that you have your treasury bills when you need them, or if you want money market funds instead, or corporate bonds. It's really important to be diversified. It was really important in the last couple of weeks to understand why global diversification was important, because with recency bias, like I was talking about, US growth has been #1 asset class for a while. And a lot of people that were overweighted in that were just fully in it, they saw huge declines. I see a lot of talk on the internet where it's really interesting. Everybody was championing, be all S&P, all S&P, all S&P. Then the crash happened, and they were like, hey guys, I'm going to start adding some international stocks to my portfolio after the fact. So you don't want to be reactionary in terms of like looking backwards like this. Like if your portfolio wasn't in the right place, it's a great learning experience, but don't make a panic decision to try and adjust to something that would have worked for what just happened. But make sure that what you're doing is, instead of planning for very specific scenarios like what we just saw, you're planning for a wide breadth of scenarios. It's really important. Yes.
I have a question from Zoom. The question is, what do you recommend that we watch then within the next 90 days?
Within the next 90 days? That's a great question. It's hard to say exactly what's going to be the right thing to watch for there, but I would just be making sure that I can fund my distributions well, making sure that I have all of my cash needs accounted for, and also making sure that I don't have sector concentration. That's going to be really important because we don't know what's going to go back on. Obviously, this is just a pause for 90 days, and it could be across the board again, but it's possible that he could say, well, you guys get a pass and you guys are all right, but you guys have not been doing what I want you to do, and it's just totally up to what he decides. And that's why I think it's really important to, one, maintain global diversification, to be diversified across stocks from all different types of places, as well as not be over concentrated in sectors. And also understanding that S&P and NASDAQ funds, they will inherently have you over concentrated in things like tech and consumer discretionary. So making sure that you're taking a look at your portfolio, seeing what types of sectors that you're overweighted in, and maybe managing a little bit of that risk. So if you hold a bunch of S&P, you can't sell it for gains. You can look at something like, you can look at that sector tracker that we were looking at. So again, if I pull this up, you can, all of these sectors are from the S&P 500. So if you have the S&P 500, for the most part, the consumer discretionary and the technology, those are going to be sort of your most highly weighted things. So you might be rotating into other sectors that aren't represented quite as much. There's another chart somewhere over here. I don't know exactly where it is right now, but you can look at some different things that show you what sectors are represented the most in the S&P 500. Or if you plug your portfolio into something like a Morningstar or some other analytical software, it can tell you where you're mostly in some sectors and whatnot. So that can be really helpful. Yes.
Economically, you can look for unemployment, interest rates, and inflation. Those are going to be the three big points that you can, and the trade will do that. And you get those numbers up in this program, right? White chart.
Yes.
Okay. That would be really cool, just to see what the current unemployment figures are that they talk about. Then with the Fed keep interest rates up or down based on the fear of inflation. That's the core stuff. All this other stuff that the president's doing, these are games. And he's playing games and trying to get his way. In the long term, and it'll just come back to those 3 points.
If you've got any questions, please feel free to ask them. But that's it for today. And I hope that was helpful.